You've probably heard the saying, cash is king 1,000 times, right? But what if I told you that for a company, having too much cash can actually be a huge problem? Well, today we're going to dive deep into that paradox and explore Michael Jensen's really fascinating free cash flow theory to figure out why. So let's just get right to it. Can a company really genuinely have too much cash? I mean, on the surface, that sounds like the best problem in the world to have. But the reality? It's way more complicated than you might think. And that's the core of the paradox, right there. A giant pile of cash just sitting around with no clear plan. Well, it can tempt even the sharpest managers into making some pretty bad decisions. Decisions that can actually destroy value instead of creating it. So how on earth does that happen? Okay, first up, let's really break down this too much cash problem. We're going to look at how what seems like a company's greatest strength can flip and become its biggest weakness. So here's the deal. A really successful company starts generating these massive cash surpluses. But if there isn't a disciplined plan for that money, it just becomes this huge temptation. Managers might start eyeing wasteful projects, things like a super lavish new headquarters, or maybe some ill-advised acquisition that does a lot more for their ego than it does for the company's shareholders.
Now, to really get why this temptation is so powerful, we need to bring in Jensen's theory and a really important concept called agency costs. This gets to a fundamental conflict that exists at the very heart of almost every corporation.
This isn't a new idea, by the way. We're going back to 1986, when the economist Michael Jensen put his finger on this exact problem. His free cash flow theory was developed to explain why even smart, rational managers can end up making some pretty irrational decisions when they're sitting on a mountain of cash.
Okay, so what exactly are we talking about with free cash flow? It's not just the money coming in the door. It's the cash that is left over after a company pays for everything it needs to run its operations and make necessary investments. You can think of it as the company's truly disposable income.
And this is where it gets interesting, because this surplus cash, it shines a huge spotlight on a classic conflict in finance called agency costs. This is basically the natural friction between a company's owners, the shareholders, and the managers they hire to actually run the business.
It all boils down to incentives. On one side, you've got the shareholders. Their goal is pretty simple, maximize financial returns. But on the other side, you've got the managers, and their personal goals might be, well, a little different. They might be thinking about building a bigger empire, funding their own pet projects, or just making their own job more secure, sometimes even at the expense of the company's bottom line.
All right, so if having all this extra cash is the potential problem, what in the world is the solution? Jensen came up with a pretty fascinating and kind of counterintuitive idea, using debt as a way to enforce discipline.
This leads us to the big question, right? If you can't always trust managers with a huge cash surplus, what do you do about it? How do you make sure the shareholders' interests are being protected?
Well, Jensen laid out two main tools. The first one is pretty straightforward. Just return the extra cash to the owners, the shareholders, either through dividends or by buying back stock. But the second one, that's where it gets really clever. He said, take on debt. Yep, by committing the company to making regular interest payments, you automatically shrink that pile of tempting excess cash.
And here's the logic, straight from Jensen himself. He said, debt enforces efficiency by constraining managerial discretion. The idea isn't to be reckless with debt, not at all. It's about creating a financial structure that forces everyone to make smarter, more efficient decisions.
The way it works is actually pretty simple. When you commit to making those regular debt payments, you're reducing the amount of free cash just lying around. And that naturally puts a limit on the funds that are available for those tempting but maybe wasteful pet projects. It's like an automatic built-in form of discipline.
But, of course, it's not always that simple, is it? This theory definitely has its critics. So for our final section, let's take a look at how this all plays out in the real world today. This constant balancing act between cash and control.
So here's the big question for today's world. Is hoarding cash always a bad thing? Critics make a really good point. They argue that for certain companies, especially in super fast-moving industries like tech, a big cash reserve isn't a weakness at all. It's a powerful strategic weapon.
So you've got this constant tug of war. On the one hand, having cash is absolutely vital for things like funding R&D, having the flexibility to jump on an opportunity, or just surviving a tough economic downturn. But on the other hand, it brings all the risks Jensen pointed out: wasteful spending, bad acquisitions, and a general lack of market discipline. It's a really tough balance to strike.
At the end of the day, the goal here isn't to get rid of free cash flow. I mean, a company that's generating a lot of cash is probably a healthy one. The real challenge, the secret sauce, is to manage that cash with discipline, with transparency, and with really strong governance that makes sure the managers and the shareholders are all pulling in the same direction.
And that kind of leaves us with one last question to chew on. If you were the CEO of a company with billions of dollars in the bank, what would you do? How would you balance the incredible power that cash gives you with the discipline needed to control it? That's a challenge that really defines